I own a full-service catering company. I'm a chef. We do weddings, large corporate events, and some government contracting. This year, we're probably going to finish at about $600,000 in revenue. One full-time employee plus myself, and I have about 12 to 15 independent contractors that help us execute our events. My question for you is that it seems that when our events actually come around, because we book them 8, 12, sometimes 18 months in advance, when the events actually come around, it seems like I'm paying for my events that have already booked with new revenue. And I'm struggling to find out if it's just a cash flow problem, if it is a process problem, or if it's just, over 8, 12, or 16 months, it's, expenses are coming up, we're having to pay them. So I was hoping that we could talk through and see how I might be able to figure out what's going on.
I'm not positive I know what you mean by pay for this event with the next one. What do you mean pay the expenses associated with executing the event you've already been paid for?
So we'll typically take a 50% deposit up front. And again, that can be, 6, 12, 18 months out. Mm-hmm. And then our expenses don't come until, after the event is executed, and we're paying for staffing, we're paying for food costs that, we purchased because mm-hmm. we're on terms. Mm-hmm. And it just seems like in my head.
So what is your margin?
So on our full service events, it is about, cost of goods runs about 40% of an event.
What does labor run?
Runs about the 25%.
Okay, that gives you a 35% margin. What other expenses?
There might be rentals,
you're going to be operating on a 25% margin with a 50% deposit.
Right.
Which leaves you with a 25% squeeze. Okay.
Yeah.
Yeah, you got a cash flow squeeze.
And I'm just trying to figure out, is it, hey, it's because it's January and February and nobody's getting married, but we still have, operating expenses. But I've tried to, when I get revenue in, to immediately divvy it up into different accounts. Like, hey, here's the money back for cost of goods. Here's the money for, payroll. Here's the money for taxes, and just keep it separate. But it just never fails that, some months it's like, hey, well, I got to pull something from somewhere to pay the electricity, or we got a problem,
Did you make $150,000 taxable income last year?
Personally?
Yeah.
No.
Then you don't have a 25% margin.
Okay.
Your margins are too thin in your world. You're not charging enough. That's one thing. Okay, there's a couple things. There's three or four things bouncing around in my head. And so, and a parallel in our world is that the book distributor, the largest in the world, is called Ingram. When we sell Ingram a pallet of books, they wait 90 days to pay us. Mm-hmm. Maybe. And maybe they'll wait another 30. Okay? And meantime, we had to pay the printer. So we're out of pocket with no cash income with that particular account. And so what we had to learn to do was accrual accounting, which was set money aside out of the deposit in your case, but also like you see, you had it in buckets, or you said bags or whatever, set it aside by category. But what's ending up happening in your case is those bags or buckets are getting bled dry because you don't have enough margin overall. Your overall operating is sucking the blood out of those buckets before you get to them.
All right.
Does that make sense?
Yeah, 100%.
That's what the math told me anyway. So one thing that will help is more accrual accounting, which is you keep each job separate and run it as a completely separate P&L. And you job cost it, it's called in the construction world. And so, and a singular event is a job that consists of revenue coming in, food cost, labor, rentals, and some percentage for operations, overhead. They add over, you deal with a builder, they'll add overhead to it, and then they put their margin on top of those things. I mean, and that would be in the construction world. That would be a job. I mean, that would be a cost plus scenario. In your case, you have to do a total bid, but and the food cost may shift on you, and you may get burned on that during that time, unless you leave that as an out in the contract. But anyway, all that to say, if you run an estimation, that'll help you set your pricing better. When you go back and look and go, okay, my estimate was X, but my actual was Y on this separate business P&L, a profit and loss statement, as if it's an individual business on this one event. You see what I'm saying?
I do.
So you get down in the weeds more on the accounting on the singular events and job cost each one of them. And that'll help your estimating for the next event, because you go, oh, I missed my food cost there. And I did that the last 3 times. So I've got to I got to change that. Or those rentals are bumping up on me. They're hitting me another 10% more than I thought they were. I'm missing those. Or I got a little scared at the last minute. They changed their numbers and I added some labor, but I didn't charge them anything for it. And you start to, whatever it is, you're in your situation, all those things that pop up. Doing an event, there's things you have to be fluid and things happen on the fly. But you got to be able to look back on the numbers and go, okay, there's a pattern here that I have to change how I'm charging or what I'm charging. Okay, that's thing one is job cost thing, and that's accrual accounting. That'll help you with the buckets. Mm-hmm. Thing 2, or the first thing I brought up, we'll call it thing 2, is more margin. I think I'm marking your stuff up a little further because I don't think you're making enough money on $600K. You ought to be making $150,000 in your world. Then the next thing is take as your profit and loss each month on the whole business, not on the individual jobs, but on the whole business. You run a P&L each month and take a percentage of your profit as an expense item and call it retained earnings. So save 10%, 15% of your profits every month into retained earnings. And retained earnings in business is your business emergency fund. It's your business slush fund. Your personal own line of credit. You're not getting into debt for a cash flow fluctuation. Or if you have a down, everything comes in January, you get nothing in March, or whatever the reverse of that is. And the month you get nothing, this is what will help you cover the cash flow fluctuations. And I had to become very disciplined about setting aside a percentage of my net profits as an expense item before I took any money home to build my retained earnings. And as soon as I did that, the retained earnings started building, and I had a lot more peace, because that's the ultimate smooth. It'll smooth out everything. I mean, if you have a bump in your world and you got $40,000 or $50,000 laying over in an account that you don't touch for anything except to grow the business or cover a problem, that'll smooth it out. I mean, if you have a $10,000 problem, you got 50 laying over there, all of a sudden your anxiety level goes way down then. And part of what puts that money over there in that account, though, is the increase in margins and the accrual accounting system. So sit down with your bookkeeper, whoever you're using for that, and have them teach you about accrual. So accrual in our world, for example, is on a book sale, we have to set aside the cost of that book when it sells, not when we buy it. And that's accrual. Cash is we have to pay for the book when we buy it, 100% of the bill, and we don't get any revenue until we get revenue. So cash basis is actual reality, but accrual helps you tie things back to the actual item. It's more confusing to operate with, but it'll help you with some of the process things, the accounting process things you're dealing with here. I think it's not going to help you as much, though, as just job costing these jobs. I think running a P&L on each of these jobs is going to be the thing for you. I think that's going to and changing your margins a little bit. Because I think by the time you factor in your expenses for operations, that's where you thought you were making a margin, and it's taking it away. Because 25% of $600K is $150. That's what you should have made. This is the EntreLeadership Podcast.